Today, we're going to be diving into rate cuts, what the probability might be, and also take a look at how this impacts the market on a bigger scale. I think you guys are going to love it. We're going to have a special interview for you. My name is Paul Barron. Welcome back into TechPath. Before I get started, I do want to thank our sponsor, and that is iTrust Capital. If you're looking at long-term holding and you want to do it in a crypto IRA, you can do that over on iTrust Capital's website. Very easy to roll over an IRA, and it's also very easy to start one. So just step in and use itrustcapital.com. You can, of course, use our link down below. It's going to get a $100 funding reward if you decide to go in that direction. You can do all things, all coins, gold, silver, all sorts of things available to get into your IRA over there. I want to lead off the show today with a clip. And the clip is our guest breaking down the potential of a Fed rate cut, but maybe also what size of rate cut we're going to take a look at. So let's go to that clip.
So a week before the July 31st FOMC, if that doesn't make enough of a ripple in the headlines such that he can press forward to get to September the 18th, he really will have waited for too long. So the longer he waits, typically the larger the rate cuts. So we could get to September and it might be 50 basis points, such that we could possibly have 150 basis points of rate cuts in theory if he's going to be playing catch up.
All right, so some pretty big statements there from Danielle DiMartino Booth, who is coming in and joining us today, who's the CEO and Chief Strategist over there at QI Research. Great to have you back, Danielle. How are you?
So good to be here with you. I'm great. I'm happy to be here.
Okay, so let's dive into your statements there. Obvious, you're pretty bullish in the sense that Chair Powell needs to move pretty quickly here. The question I guess everybody's asking is, what does that look like for the third quarter? Do we see a September, maybe a November, or even maybe pushing into December? What are your thoughts?
I think that once the Fed does get going, unlike some of its international counterparts, I think that once the Fed does get going, because we have waited so long, that it's going to keep going. And I suspect that if it begins with a 50 basis point with a 0.5 percentage point rate cut in September, that we could probably see one 2 days after the election on November the 7th, when they unusually meet. It's fairly unusual for the Fed to have a 2-day meeting conclude on a Thursday, but that is the case.
All right, I'm looking at a couple of the speculation markets out there. Polymarket, we follow this one pretty heavily. Right now, I'm looking at the September 8 rate cut potential, September 18th. This is about an 87% probability. It has been climbing right now. Danielle, when you look at September versus going into November or even into late year in December, what makes the market so bullish on this September date?
Well, I think the market is bullish if you're betting on when the rate cuts are going to occur.
Right.
Of course,
yeah.
you can put your money on anything, right? I mean, we can bet on anything. I think they're bullish because the bad news in the job market is it's gaining enough critical mass to be highly problematic for the Fed if they don't go ahead and make the move.
So you think this is a scenario that is forcing Powell's hand right now based on some of the macro elements that we're seeing, obviously, from jobs, what we're seeing in terms of the surprise inflation rate that started to adjust pretty significantly here on this last report. Do you think that's the key thing, that Powell doesn't want to get in a position to where he cuts too late in the year and then gets blamed for a free fall in terms of the economy?
Well, I think we may be overanalyzing Powell's the way he's thinking about approaching this first rate cut. I really do think that he is waiting for certain thresholds to be breached, for a certain amount of duration and persistence in the direction of the data. You know, if we were to see the unemployment rate tick up again, I think that would certainly be enough evidence for him, given the Fed's own year-end 2024 target for the unemployment rate is 4.0%, and it's already at 4.1%, and that's just through the June report.
Okay, so let me throw a scenario at you. If we get a CPI rating on our next report, and it's either flat or even slightly up, what would that do to Powell's position for a rate cut?
So I think that would that would certainly make him a little bit more reticent. And we have something called the base effect that will be kicking in later in the next few months to make it where you really would have to see much lower prints to not see the year over year CPI rate begin to tick up. So perfectly plausible that he would be able to say, you know what, it was a good thing we didn't go on July the 31st because we saw a little bit more pressure on the inflation front. But let's get real. In data back to 1936, goods prices, goods deflation of negative 4.1% year over year. These are things that we want to buy. These are discretionary goods as opposed to things that we have to buy, which is filling up our gas tank and putting food on the table. But that level of deflation, negative 4.1% year over year, is the deepest in data back to 1936. Powell is arguably overdoing it right now.
Yeah, so, and I think that's what a lot of people are looking at. It's interesting that the market has been as resilient as it has been. Granted, there's been a variety of factors that have been, kind of implicating, I think, some of the growth, obviously, with the tech stocks, but we've also seen what's happening here on the risk markets with what we cover a lot on the crypto side of things. You look at where the Fed is right now and where the national debt is, and we continue to see the printing really accelerated. I mean, just in the fact of the amount of interest rate that we're incurring on a monthly basis. How does this play out for the Fed on a more longer term scenario? Because I know you were talking about a pretty accelerated ramp on a rate cut. I'm looking at, say, 2 quarters into 2025. Where do you feel like we will be in terms of our rates at that time?
You know, it's perfectly feasible that by the time we get into the first quarter of 2025, that we've got interest rates 100 basis point, 1 full percentage point below where they are today, if not even possibly more. It really does depend on the rate at which job losses accelerate. It depends on the rate at which disinflation continues to push its way through. I mean, goodness gracious, you've got shelter inflation rising by 3.3% year over year. It wasn't but 3-4 months ago that we were talking about shelter inflation being so sticky it wouldn't be coming down this year at all. And now it's back to pre-pandemic levels. So he has to be very cognizant of the risk and the specter of deflation, because central banks can fight inflation all day long. They have very few tools to combat deflation.
Yeah. Well, and that's the thing that's been kind of tossed around a bit, is that it's a shift from disinflation to seemingly more focus on deflation. To your point, the Trueflation index, this is the U.S. inflation index, continues to fall. We've continued to see that through the last couple of months here. Pretty sharp decrease off that 2.68, and coming down, to your point, in a pretty accelerated fashion. My question is, how quickly do you think this continues at this pace? Because this is a pretty sharp pace. If you think of Trueflation just on its own, this is a pretty sharp pace. Does this have that residual effect in the economy where we continue to see a pressure on prices, goods and services, especially as jobs start to get a little bit softer in the overall market? Could we be seeing a little bit more of a bottom here in terms of inflation?
Yeah, I think I think that you are speaking to the crux of the matter, and that is what's driving inflation.
Right.
And if what's driving inflation is job loss, you're talking about somebody who's going from having a paycheck to not having a paycheck. There is no stronger depressant on prices in the world than losing your paycheck. And what we know, because continuing claims have been as stubbornly high as they are, is that once you lose that job, it's become increasingly difficult to get a new one. And that's a serious shift from maybe 18 months ago, when all you had to do was fog a mirror to get a job, and a good paying one at that. So we really have seen a marked change in the job market, because it's just not what it was 18 months ago. It's much more difficult to get a new job.
Have you seen, I know you've been covering this on QI Research, and I read your Quill newsletter. You guys do a great job on that. You've been covering this for quite a while, and you've seen these cycles before, obviously working at the Dallas Fed, et cetera. How important is this cycle with what we're seeing of how the Fed is responding to the current inflation scenario, the global economy impact that we're seeing from a macro standpoint, and what's happening in the job market. Is this a kind of a perfect storm that seems to be brewing right now?
Well, it's perfect in the sense that when you see data out of Germany, for example, right, the world's third largest exporting nation after the United States and China, when you see that its industrial sector is slipping back into recession and that consumer confidence is stepping back once again, when you see that the challenges in China's property market are not really improving as much as we would like to see, when you see the weakness in terms of lenders charging off credit card bad debts here in the United States, you do start to see a confluence of factors coming together at the same time. I think the difference right now is that now we're kind of finished talking about a soft landing. There are very few people out there anymore who are talking about a soft landing. I mean, very, very few. So we've had the United States kind of as this cushion for the rest of the world for some time. I don't think that that's the role that it's going to play now, even as we're seeing Germany and China kind of double dip into weakness.
So, okay, so that goes into the point that you just referenced there in terms of soft landing, the parameters that seem to be aligned right now from a global position from where the U.S. is, even if you look at what's happening in the BRICS entities that are trying to de-dollarize in terms of their trade. Now you play into just the U.S. side of it from a job standpoint. At what risk does Powell have if we do see a landing that may end up in a very bad position in 2025 or 6? Where does Powell stand in terms? I was looking at your tweet right here. 1933 Supreme Court precedent. This was dictating that Powell could not be fired by a president. How does this play out if this goes sideways on Jerome Powell?
Well, it's the closest parallel one can draw to the Supreme Court precedent is that of Congress always walking up to the edge of thinking about getting rid of the filibuster and then quickly stepping back and saying no, no, no. So right now, as the law stands, if let's just say Jay Powell was to be fired, the Federal Reserve Board in Washington, D.C., they could opt to keep Jay Powell in his position until the Supreme Court ruled on Humphrey, which was the 1933 precedent. So they would, even though the majority of the people on the Federal Reserve Board are not philosophically aligned with Jay Powell, they're a lot more progressive. They advocate for things like monetary policy, addressing climate change, central bank digital currencies, all things that Jay Powell is adamantly opposed to. Even though they're not philosophically aligned, he's much more conservative than they are. Boy, they would not want to set the precedent, if they could prevent it, of having a president come in for political reasons and saying, I'm going to switch you out. So they would make sure that they weren't in the same position themselves one day by keeping Jay Powell in his position until the Supreme Court ruled. And we know that sometimes it takes the Supreme Court a while to rule on things. So you could theoretically easily get to May of 2026, by the time this finally happened, if there's a change in the current administration that won't really take place until, call it, February 2025. So there's not very much time there to get rid of Powell. And given how slowly the Supreme Court works, we would safely be able to keep him in office.
Interesting. Here's one that, and I want to just get your opinion on this. This came in from Kobeisi. This is Financial Times. Donald Trump warns the U.S. Fed chair not to cut rates before the election. So saying that, this kind of puts a little bit of a political push on it.
Yeah.
What's going on here? Is he just trolling?
He's adorable. Yeah, he is, and he did. He did the entire time. I mean, he did the whole time that Powell was in office. He did
just
this.
Trolled him.
And I know on a personal level, so you can take it on exceedingly good authority, that it didn't matter then, and it's not going to matter now.
Doesn't matter now.
Powell was never swayed by being bullied. He's not going to be swayed by being bullied again. I know that it is really hot and sexy stuff, and they tweeted. I've had, how many tweets have I had about this? I just had somebody else come into my feed. I pinned the 1933 precedent about why and how, specifically how Powell cannot get fired. Not necessarily can Trump attempt to do this? Yes, but I've pinned the reason why he cannot be onto my Twitter feed, and I still get questions constantly.
Yeah.
What happens if he gets fired? You know, what happens if Trump bullies him? I mean, it's just, and Powell's, he doesn't care.
Danielle, I want to play a clip for you. This is talking about where the market growth may go to, and we've seen obviously some pretty successful ETFs. The Bitcoin ETF, we're getting ready to get an Ethereum ETF. These are, more the blockchain side. But I want to play this clip for you and get your opinion on it. Let's go to that clip.
Is there some new wave that's going to open up? What are you going to tell people tonight?
The next $10 trillion are going to be driven by clients, not by us. Attending to the interest of young investors, do-it-yourself investors, millennials who are buying ETFs for the first time.
Ether is a much smaller product in terms of assets under management than Bitcoin. What are we expecting?
So give it a 6-month run. I think we'll look at this and we'll say the ETH funds have about 10% of what's in the Bitcoin funds. If a Solana ETF comes next, I think it's going to be an even smaller allocation.
Do you have a strategy here?
Yeah, Bob, I'm a big believer in digital assets. I think that whether we like it or we hate it, we have to pay attention because this is where the money is going, this is where investors are. But what's exciting to me is digital asset 2.0. What is the next version? And that's why we partnered with Galaxy Capital, because we think that the expertise lies with crypto natives.
What does this involve?
It's not going to be about the Bitcoin, it's not going to be about Ether, it's going to be the entire digital assets ecosystem. How do we hedge the volatility within a portfolio?
Interesting way to do this.
All right, so Danielle, you can kind of see, mainly what I wanted to connect there was the fact that we're seeing a shift in the makeup of maybe Wall Street investment going forward over the next decade, 2 decades. With that being a bit of a shift, how does that affect what happens on the bureaucratic side, whether it's the Fed, what we'll see with the SEC? How do you see this playing out from that standpoint with a whole new, it's no longer the boomers that are in control of most of the funds over the next 20 years?
Well, it will certainly be more concentrated in the hands of the Gen Xers, right?
Right.
Right now, I think one of the challenges is that so many of the younger investor cohort is in the crosshairs of AI. So I think a large chunk of these generations are going to have to reinvent themselves as something else.
Yeah. Interesting.
And there'll be a lot of multi-generational household formation. As a result, they're the least kind of financially independent, if you will. So I think it's going to take some time for these shifts that you describe to take place. We will definitely see more automation going forward in terms of the mechanism by which younger people invest, but we've already crossed the threshold, right? We're already seeing more than half of all new funds pour into an index or an exchange traded fund. The structure of the market is forever changed, even for anybody in America who's got a 401k.
Right.
So I think that will continue, but along the way, if there's a serious correction in the stock market, I think that there might be an interim period in which returning to old-fashioned active management, where you're actually choosing which investments to be in, might be making a temporary comeback in between, just because you at some point you actually have to choose winners and losers, and I think we might be headed that way. It's interesting you asked this question because the Vanguard Total Stock Index Fund, which is the largest ETF on planet Earth, while it's returned handsomely for the year 2024 in terms of flows, they've been flat as a pancake.
Yeah, exactly.
So again, we're watching some of this. Occur in real time. We're going to have to get past the baby boomers leaving the market, and we're going to have to get past some of the very low anemic hiring that we're seeing for the class of 2024 before we can cross this lovely bridge to what you're describing. Which I think will be more of a 2026, 2027 possibly event.
Interesting. Okay. All right. Well, I mean, that's still around the corner. You look at this shift that is happening with Wall Street, we'll hit this on kind of our last topic. The shift that's happening with Wall Street, Larry Fink, I know you and Larry have kind of been back and forth on a variety of topics, but tokenized U.S. Treasuries, reaching 3 billion by end of year. That's pretty accelerated considering the current tracing of where we are right now. And even if you look at some of the ones that have been on this, you look at Biddle, et cetera, that has been, which is part of the, the effort of what BlackRock is trying to do in terms of changing this. And I've listened to Larry, quite a bit in terms of his strategy. He seems to be very all in on this shift that seems to be happening with Wall Street as a whole. What is your opinion of that in terms of tokenized treasuries, what we'll see in all sorts of these different kind of macro markets, whether it's stable coins, global bonds, private credit, et cetera? What's your thoughts?
Well, I certainly do think that the application is appropriate. And as far as Larry Fink wanting to be on the ground floor, why not? Because if you're on the ground floor of, say, I don't know, the Spider, you might end up one day running, $11 trillion in assets under management. You never know.
Yep.
So being on the ground floor, strategically speaking, for anything with that magnitude of potential is certainly an attractive position to be in. We all want that first mover advantage, right? But I will say that the central clearing of treasuries is a much more important development that we've seen this year, because now we're going to have a lot more in the way of transparency in terms of who's transacting in that market, how much leverage they're using to trade those treasuries. But again, much more like something that is cleared as opposed to something that is traded in the shadows. So I take my hat off for that evolution, knowing that the Chevron decision, and especially a new Trump administration, would change, would defang a lot of some of the ideas that regulators have had with respect to many different aspects of the financial markets. So I think that the progress that we've seen that's been made might be arrested for a bit.
Yeah, for sure. Danielle, I want to get a prediction from you, because you're kind of leaning into a couple of points here that I want to touch on. One is possibly, most likely, not a soft landing. How do you think this plays out from an economic standpoint? Do you think we are in for a true recession coming in?
Well, I think we are in recession. As for when we exit recession, again, if the Fed manages to wait until September to launch, then they will have waited a similar amount of time to that which they did before the great financial crisis. And the Fed waiting that long, even though we eventually came out of it, it made for an 18-month recession as opposed to your average post-war, which is closer to 10 months, an 18-month recession as opposed to your average kind of a 10-month slowdown. So certainly the Fed waiting for as long as they have could prolong the current recession.
Danielle, it was great having you on the show. If you guys want to learn more about her, you can hit her on X at DiMartino Booth. She's got all sorts of links in here, including her book, Fed Up, which I've read, and it's a fantastic book. So make sure and check that out as well. Thanks for coming in on the show today. We appreciate it.
And thank you for having me.
You bet. All right, you guys are tuned in maybe on the podcast side of things. Make sure and jump into the YouTube channel. This is where you're going to get additional content and also more of an engagement, I think. Of a lot of times the charts we share that you don't get the full effect here on the podcast side. The YouTube side is going to be the place for you. Like a video or two, it's going to end up in your algorithm and in your feed. Hopefully it'll take you down a rabbit hole and start your course on education around blockchain and some of these new assets that are starting to populate the financial system. If you're not a Diamond Circle member, get in on that as well. It's very easy. We'll leave a link down below. Catch me out there on X at Paul Barron. We'll catch you next time right here on TechPath.